Are super high-yield dividend ETFs safe to invest in? What's up, everybody? Wealth Wisdom Investor here. In this video, we're diving deep into whether super high-yield dividend ETFs, which have been gaining in popularity for a while now, are actually safe investments. I'll also cover essential concepts that every investor should understand when considering high-yield ETFs. So, whether you're a seasoned investor or just getting started, I recommend you read this from start to finish. The rise of high-yield dividend ETFs. High-yielding dividend ETFs began gaining traction in the mid to late 2000s, particularly after the 2008 financial crisis. During that period, investors were searching for safer income-generating investments due to increased stock market volatility and historically low interest rates. Traditional fixed-income investments like bonds weren't attractive, and the rise of ETFs, which offer diversification and lower fees, made dividend-focused ETFs a compelling alternative. Back in 2010, Vanguard launched its High Dividend Yield Index Fund, VYM, which was trading around $35 per share. At that time, VYM had a dividend yield of about 3.1%, which was significantly higher than the S&P 500's 1.8% yield. Given that interest rates were near 0% back then, it made sense for income-seeking investors to turn to dividend-focused ETFs. VYM has provided solid total returns over time, yet still underperformed the broader S&P 500. The super high-yield ETFs, are they safe? As investors' risk appetite increased post-2008, we saw the birth of super high-yielding ETFs. One such example is Global X's Super Dividend ETF, SDIV, which launched in 2011 and holds various high-yield stocks worldwide. SDIV currently boasts a high yield of around 11%, but also carries a hefty expense ratio of 0.58%. However, a look at SDIV's stock price tells a cautionary tale. It has trended downward from around $80 per share at inception to just $21 today. Even when factoring in dividends, its total return since inception has been negative, minus 10%, whereas the S&P 500 returned 484% over the same period. This poor performance is often due to SDIV's focus on high-yield, low-quality stocks, which struggle to sustain dividends and are vulnerable to rising interest rates. High yields often mean higher risks. In my experience, whenever I see a yield above 8%, it often signals risky assets such as junk bonds, risky mortgage-backed securities, leveraged investments. Super high yields frequently come with increased volatility, a greater chance of dividend cuts, and declining stock prices. The rise of covered call ETFs. Another class of high-yield ETFs includes covered call ETFs, also known as CEFs. These funds generate income by selling options against their holdings, earning option premiums alongside stock dividends. Some of these ETFs can outperform for periods of time, but they typically come with trade-offs. One well-known high-yield covered call ETF is QYLD, Global X Nasdaq 100 Covered Call ETF, which launched in 2013. It employs a covered call strategy on the Nasdaq 100 and has a massive trailing 12-month distribution yield of 12.6%. However, a look at its stock price history shows a consistent decline from around $25 at inception to about $18 today. When considering total return, stock price plus dividends, QYLD has returned 146% since inception, whereas the S&P 500 returned 339% over the same period. This makes QYLD more suitable for cash flow-focused investors rather than those seeking long-term growth. The issue of sustainability. A declining stock price often indicates that a fund's high yield may not be sustainable. Some ETFs attempt to maintain high distributions by implementing reverse stock splits, but that's typically a red flag. Reverse stock splits. A warning sign? A reverse stock split consolidates shares to increase the stock price artificially. While it doesn't change the ETF's fundamental value, it can signal deeper problems. Reverse splits can reduce liquidity, increase price volatility, signal ongoing underperformance, make tax reporting more complex. Understanding net asset value, NAV. An ETF's net asset value, NAV, is the total value of its holdings minus liabilities, divided by the number of shares outstanding. If an ETF stock price consistently trades below its NAV, it could indicate undervaluation or deeper issues. A declining NAV often leads to distribution cuts, meaning investors may see lower income over time. Return of capital, ROC. Good versus Bad. Return of capital, ROC, occurs when an ETF distributes more cash than its income. There are two types. Good ROC, used strategically for tax efficiency, deferring taxes until shares are sold. Bad ROC, unsustainable payouts, returning investors' own capital, leading to long-term NAV erosion. QYLD and similar covered call ETFs often classify distributions as ROC, which can temporarily sustain high payouts but could also signal unsustainable distributions. Tax considerations for high-yield ETFs. High-yield ETFs often pay ordinary income, which is taxed at higher rates than qualified dividends. In taxable accounts, this can result in a higher tax bill compared to investing in ETFs with qualified dividends or long-term capital gains. Alternative high-yield investments. Beyond covered call ETFs, other high-yield investments include closed-end funds, CEFs, often use leverage for higher yields, but come with greater risk. MLP ETFs, energy sector focused, offering high yields but complex tax structures. Preferred stock ETFs, act like bonds, providing fixed dividends with lower volatility. Emerging market ETFs, offer high yields but come with geopolitical and currency risks. Do any super high yield ETFs outperform? While most super high yield ETFs underperform over time, there are exceptions. For instance, YieldMax's NVDY ETF, which employs a synthetic covered call strategy on NVIDIA stock, returned 191% in just over a year while boasting a yield of over 50%. However, such performance is likely unsustainable long-term. My personal approach to high-yield ETFs. I personally allocate only about 5% of my portfolio to super high-yield ETFs, with my main exposure in JEPI and JEPQ. These ETFs aim to generate high income while maintaining more stability than some riskier alternatives. Conclusion: are super high-yield ETFs safe? The answer depends on your risk tolerance and investment objectives. While high-yield ETFs can provide attractive income, they often come with significant trade-offs, including declining stock prices, distribution cuts, higher tax burdens, increased volatility. Before investing in any high-yield ETF, be sure to analyze its historical performance, understand its income sustainability, check expense ratios and tax implications, research fund management quality. Final thoughts. If you're considering investing in super high-yield ETFs, I recommend limiting your exposure and not going all in. Always read the fund's prospectus and evaluate its long-term viability. If you found this breakdown helpful, please hit the thumbs up button, subscribe, and click the bell notification to stay updated on my latest content. Thanks for watching, and stay positive.